Welcome everyone, and thank you for joining me today. I'm excited to present to you a structured approach to significantly enhance your trading performance. Today's session is titled Professional Trading Framework, and we'll explore how mastering smart money concepts can lead to more precise trade entries. We'll look at high-accuracy setups, understanding how major market players execute their selling strategies, and uncovering the institutional logic behind high-probability sell setups in both Forex and crypto markets. So, let's dive in and start building a solid foundation for smarter trading. Let's take a closer look at what's happening in this zone. Price often revisits this area to fill remaining institutional orders before it continues its downward trajectory. This supply zone acts as a key resistance level where we can expect the price to react, often hesitating or revering because of the supply pressure. Now, when we see a strong, impulsive move downward, that's a clear sign of significant institutional selling pressure entering the market. It's like the big players are stepping in aggressively, pushing the price down quickly. Another important point is the last bullish candle before that sharp drop. This is often called the last bullish candle, and it's crucial because it marks the final push of buying before the market shifts gears and drops sharply. This brings us to the concept of a bearish order block, or OB. This is identified as the last bullish candle formed immediately before a significant bearish impulsive move. Think of it as an area where institutional players accumulated sell orders. They built up supply here, creating an imbalance between supply and demand. That imbalance then triggers a sharp decline once enough sell orders are in place. So, in essence, a bearish order block is a key area to watch because it signals where the big players have been accumulating sell positions, and it often marks the beginning of a strong downward move. Recognizing these helps us anticipate potential reversals or continuation points in the market. Let's take a closer look at the order block. It represents the remaining institutional sell orders that are waiting to be triggered. When we talk about a bearish OB, we're referring to unfilled sell orders. Essentially, the large sell positions that institutions have placed but haven't yet executed. Now, here's an interesting dynamic. Smart money often capitalizes on retail buying activity. They do this by placing their large sell orders at strategic points, usually at prices where retail traders are likely to buy, especially during perceived breakouts. This way, they can fill their substantial sell orders without causing a significant price impact. This creates a scenario where institutions are effectively selling into buying pressure. Retail traders, thinking they're jumping into a breakout, buy up the asset, which provides the liquidity institutions need to execute their large sell orders at favorable prices. So, retail traders are often buying breakouts, believing they're catching the next big move, while institutions are strategically placing their large sell orders at these times, often at premium levels. And to do this effectively, banks and other large players distribute their sell positions at these optimal, often higher, prices, what we call distributing sell positions at the right levels to maximize their advantage. All of this fits into the broader institutional logic behind the bearish OB. It's a strategic game. Institutions are looking to sell into the buying activity of retail traders, leveraging their orders to maximize profit, all while retail traders are caught on the other side, often unknowingly. Let's break down the key points on this slide. First, we see that the equation is trend plus structure equals probability. This means that understanding the overall market trend and its structure significantly increases our chances of a successful trade. When we observe a powerful downward move, it often confirms institutional intent. That is, the big players are actively pushing the market lower, and it also validates the formation of an order block, or OB, which we can use as a potential entry zone. Next, a strong bearish impulse is crucial. It indicates that sellers are in control, pushing prices lower with momentum. This often involves price sweeping equal highs or previous resistance levels, clearing out buy stops along the way. That's a sign of liquidity being taken from the buy side, which often leads to further downside movement. Then we look for a decisive break of previous swing lows. This is what we call a clear break of structure, or BOS. When the market breaks those lows convincingly, it signals that bearish momentum is continuing, confirming that the trend remains downward. Finally, it's important to confirm a bearish bias on higher timeframes, like the daily or 4-hour charts. A clear downtrend on these larger timeframes increases the probability that our lower timeframe entries are aligned with the overall trend. And remember, to maximize our success rate, we only want to trade bearish order blocks when specific market conditions are aligned. That's what we mean by market conditions for high accuracy, waiting for the right setups, the right trend, and structure to come together. That way, we're trading with conviction and increasing our chances of success. Let's walk through the process of identifying a valid bearish order block. First, we start by drawing the order block from the open of the last bullish candle up to its high. This helps us pinpoint where the buying activity was strong before the market shifted. Next, we look for the final upward moving candle before an impulsive bearish move. This is key because it often signals a potential area of supply or resistance. Then, we need to confirm a break of structure by checking if the price has broken a significant swing low, creating a lower low. This confirms that the overall trend is turning bearish. We also want to identify where equal highs or buy-side liquidity has been targeted aggressively, as these zones often serve as liquidity pools that the market will seek to sweep before continuing downward. Finally, it's important to determine the overall higher timeframe bias, usually bearish in this context, so our trade aligns with the larger trend. By following these steps, we can precisely pinpoint high-quality bearish order blocks, giving us a solid basis for our trading decisions. Confirmation is key when entering a trade. It's important to wait for clear signs of rejection or a lower timeframe shift, as jumping in without these signals greatly reduces our chances of success. Always be patient and seek confirmation before acting. Avoid the temptation to sell blindly. A strong bearish engulfing candle or an impulse candle closing below the order block is a solid indicator that the market is ready for a bearish move. This kind of candle confirms that sellers have taken control and that we can consider a short entry. Next, look for a market structure shift on a lower time frame, like the 5-minute or 1-minute chart, within the order block zone. These shifts help us pinpoint the right moment to enter, aligning our trade with the current market momentum. Additionally, watch for signs of rejection, such as strong wicks or candles that show hesitation as price enters the order block. These are clues that the market is rejecting higher prices and may soon move lower. Price retracement is another critical aspect. We want to wait until the price retraces back into the marked bearish order block before executing our trade. This ensures that we're entering at a more favorable level, increasing the probability of a successful move. By combining these elements, confirmation, candlestick signals, lower timeframe structure shifts, rejection signs, and retracement, we can execute high-probability sell entries with precision. This disciplined approach helps us avoid blind trades and aligns us with the overall trend, enhancing our trading consistency and success. Discipline protects capital and ensures longevity in trading. It's really the backbone of staying in the game for the long haul. When it comes to stop-loss placement, it's crucial to set it where the entire bearish premise of the order block is invalidated. This is what we call the invalidation point. By doing this, we make sure that our trade is only active as long as our analysis holds true. Now, let's talk about risk management. I always recommend limiting your risk to about 1 to 2% of your total trading capital per trade. This way, even if a trade goes against you, it won't significantly impact your overall account. Managing risk effectively keeps you resilient and preserves your capital over time. Another key point is adding a small buffer above the wick of the order block high. This buffer, just a few pips or ticks, helps account for spread and market volatility. It prevents your stop from being hit prematurely due to normal market fluctuations. When placing your stop loss, it's best to position it precisely above the highest point of the bearish order block. This placement protects your position while still giving it room to breathe, so you're not getting stopped out by minor fluctuations. Finally, overall, strategic stop-loss placement is about protecting your capital. If the price breaches your stop, it means your analysis has been invalidated, and it's time to exit the trade. This disciplined approach helps you stay consistent and avoid emotional decisions, which is key for long-term success in trading. Let's talk about optimal risk-reward ratios. Ideally, I aim for trades that offer at least 3 times my initial risk, which we call a 1-to-3+ ratio. This means if I risk $1, I want to see potential profits of $3 or more. On the other hand, the minimum acceptable ratio is 1-to-2, so I'm looking for at least twice my risk in potential profit before entering a trade. Now, understanding key concepts like fair value gaps, or FVGs, is crucial. These are inefficiencies in price action that often get targeted for rebalancing. When the market leaves behind these gaps, they present opportunities to jump in when the price revisits those levels. Then we have equal lows, which are horizontal levels where price has previously tested support or liquidity. These levels often act as support zones or liquidity grabs, meaning traders might be looking to push the price below these points to trigger stops. Below these equal lows, you'll find sell-side liquidity zones, areas where stop losses are clustered, making them attractive targets for market movers. And of course, the previous swing low is a natural level to watch, as it's where buyers once stepped in, so it can serve as a logical target or level of interest. When identifying optimal targets, the goal is to find high-probability profit zones that promise a good risk-reward ratio. This helps ensure that even if you're wrong sometimes, your wins outweigh your losses. Finally, for take-profit targets, I focus on these high-probability levels, whether they're based on support and resistance, liquidity zones, or other market structures. Setting clear profit targets aligned with these concepts helps me stay disciplined and maximize the potential of each trade. Smart money waits, so you should too. Patience is key in trading, especially when it comes to avoiding unnecessary risks. Excessive leverage might seem tempting, but it can magnify your losses very quickly and even wipe out your trading capital. So always be cautious with leverage and avoid overextending yourself. When it comes to over-leveraging trades, remember that not every bullish candle is a valid order block. Look for strong, impulsive follow-through to confirm your setups. Just because the market looks bullish doesn't mean it's ready for a reliable entry. Confirmation is everything. Marking weak candles as order blocks is a mistake many traders make. Not every candle, even a bullish one, represents a solid support zone. Be selective and wait for signs of strong momentum before acting. Jumping into trades without considering lower timeframe market structure shifts or strong rejections is risky. Always look for clear signs that the market is aligning with your plan before entering. Patience and confirmation are your best friends here. Failing to identify where buy-side liquidity has been taken can lead to premature entries. Knowing where liquidity is located helps you anticipate market moves and avoid getting caught in false breakouts. Ignoring the liquidity context and the higher timeframe bearish bias often leads to low-probability setups. It's crucial to keep the bigger picture in mind. Otherwise, you might be trading against the overall trend, which increases your risk. Selling against the higher timeframe trend is generally not a good idea unless you have a very strong reason to do so. Always respect the overall trend direction to improve your chances of success. By avoiding these common pitfalls, you'll be able to improve your accuracy when trading bearish order blocks. Staying disciplined and aware of these factors is essential for consistent, profitable trading. Now, as we wrap up, remember that effective selling happens where institutions sell. That means you need to ask yourself, is your stop loss placed correctly? Have you clearly defined your risk? Managing risk is crucial, so always ensure you're following a disciplined approach. Next, look for lower timeframe signals like a MSS or a strong rejection. These can give you an early indication that the move is likely to continue in your favor. Entry confirmation is vital, so identify a strong, valid bearish order block to support your decision. When assessing a valid bearish OB, check if there's been a clear break of structure to the downside. That's your BOS confirmed signal. Also, consider whether buy-side liquidity has been swept. Liquidity taken can often indicate a trap or a sharp move down. Now step back and look at the bigger picture. Is the higher timeframe trend clearly bearish? If it is, that aligns with your bearish bias and adds confidence to your trade setup. Finally, before executing any trade, make sure all these critical criteria are met. This comprehensive checklist helps you identify high-probability bearish trades, keeping your approach disciplined and focused. Remember, consistency in applying these principles is what separates successful traders from the rest.